Construction is 6 months behind schedule. The EPC contractor has claimed force majeure for 3 weather events, each of which lasted less than a week. The Liquidated Damages clause has no cap. The contractor's legal team has advised them the provision is unenforceable. The DFI has frozen disbursements pending an independent construction report, and the developer is funding the overrun from equity reserves that were sized for contingency, not for a contractor dispute. This is not a construction problem. It is a contract problem. The EPC contract determines whether cost overruns and schedule delays stay with the contractor or fall back on the developer and ultimately on the DFI. Episode 10 shows you how to structure the EPC contract correctly before you break ground.
Zara, welcome to Episode 10. We've covered the financial model, the ESER, and the offtake agreement. The EPC contract is the 4th pillar, and I think it's the one that developers most often treat as the contractor's problem rather than their own structuring responsibility.
That is exactly the mistake. The developer who lets the EPC contractor draft the contract on the contractor's standard terms will end up with a contract that allocates every uncertain risk to the developer and every manageable risk to the contractor. The developer's job, and the DFI's requirement, is a lump sum turnkey contract where the contractor bears cost and schedule risk for the scope they have agreed to deliver. That structure does not happen automatically. It requires deliberate structuring, careful negotiation, and DFI standard legal documentation. Let's start with the contract types. There are 5 primary construction contract types used in African infrastructure. The lump sum turnkey, LSTK, or EPC contract, is the DFI's preferred structure. The contractor agrees to deliver a complete operational facility for a fixed price by a fixed date, bearing all cost and schedule risk within the agreed scope. EPCM, engineering, procurement, and construction management, is not bankable for DFI project finance because the developer retains cost overrun risk. Cost plus or reimbursable contracts are never bankable. CapEx is open-ended, and the financial model cannot be closed. The design-build contract is acceptable if it is fixed price with performance guarantees, and the O&M contract is a separate operations agreement that follows the EPC contract after commercial operation. The DFI reviews both.
Why is the EPCM structure not bankable? I hear developers arguing that it gives them more control over the construction process.
Under EPCM, the contractor manages construction but does not take lump sum price risk. The developer pays actual costs plus the management fee. That means if steel prices increase, if subcontractors underperform, if quantities are higher than estimated, the developer pays. The DFI cannot size the debt facility against an open-ended CapEx number. The financial model requires a fixed CapEx to calculate IDC, DSCR, and the equity contribution. If CapEx can grow unbounded, the model is unbankable. The LSTK structure fixes the price. The DFI sizes the facility. The developer's contingency covers the defined uncertainty. That is the structure that closes. Everything else creates restructuring risk that the DFI will price or decline. The lump sum turnkey EPC contract has 7 defining characteristics. First, the fixed contract price, an agreed lump sum that the contractor cannot exceed unless a change order is approved by the developer, and, above a defined threshold, by the DFI. Second, the fixed completion date, a contractual commercial operation date beyond which the contractor pays delay liquidated damages. Third, the performance specification, output, availability, and efficiency targets that the contractor warrants and that are tested at completion. Fourth, full contractor responsibility. Design, procurement, supply, construction, testing, and commissioning are all within the contractor's scope. Fifth, turnkey delivery. The contractor hands over a fully operational facility. Sixth, the defects liability period, 12 to 24 months of contractor warranty post-completion. And seventh, FIDIC alignment, using FIDIC Silver Book as the base contract, which DFIs are familiar with and prefer.
Why does FIDIC Silverbook matter specifically? Developers often ask whether they can use their own contract template.
Most DFIs have their own legal teams and independent legal advisors who are deeply familiar with FIDIC Silverbook, the EPC and turnkey project's conditions. Using a known base reduces legal review time at financial close and reduces the risk that non-standard provisions create unexpected legal risk. When a developer uses a contractor-drafted template or a locally adapted contract, the DFI's legal advisor must review every clause from scratch, which adds weeks to the financial close process and often generates a long list of required amendments. The DFI will require that the EPC contract be reviewed and approved by the independent engineer before disbursement begins. That review goes faster and results in fewer conditions when the base is FIDIC Silverbook with standard deviations clearly documented. Risk allocation is the core of EPC contract structuring. The developer's goal is to transfer as many construction risks as possible to the EPC contractor. The contractor's goal is to limit their exposure to risks they cannot price. Understanding where the boundary sits and how to negotiate it is the developer's most important skill in EPC contracting. Under a well-drafted LSTK contract, the contractor bears design risk, procurement cost risk, construction risk, schedule risk, performance risk, subcontractor interface risk, and latent defects risk during the DLP.
What risks does the developer always retain, even in the best structured LSTK?
The developer always retains site conditions risk where the developer conducted the geotechnical survey. If subsurface conditions are different from what was represented, the contractor has a change order entitlement. Permits and approvals risk. The developer is responsible for all regulatory approvals, and if a permit is delayed, the contractor is entitled to an extension of time. Grid connection and infrastructure interface. The developer must deliver the connection point on schedule. Developer-initiated change orders. Force majeure events. Natural disasters beyond either party's control. And of course, all revenue risk after SODI. That is the developer's risk and the DFI's lending risk, not the contractor's. Liquidated damages are the financial penalty mechanism that makes the EPC contractor accountable for delay and underperformance. There are two types: delay LDs, a daily rate payable for each calendar day the project misses the contractual commercial operation date, and performance LDs, a lump sum payable if the plant's tested output, availability, or efficiency falls below the guaranteed levels. Delay LDs must be calibrated to cover the developer's actual losses from delay, typically the lost revenue and increased IDC during the delay period. A typical delay LD rate is 0.05 to 0.1% of contract value per day.
You mentioned earlier that the hook scenario involved an uncapped LD clause. Why is capping the LD so important? And what does the cap typically look like?
A cap on liquidated damages is essential because without a cap, the contractor's total exposure is unlimited, and no competent EPC contractor will sign an uncapped LD clause. In the best case, the contractor prices the unlimited risk into the contract price. You pay a large premium. In the worst case, they walk away from the contract when LDs start accruing, precisely when you need them most. The standard cap is 10 to 20% of the contract value. This is sufficient to cover delay cost and performance shortfalls in most scenarios. Beyond the cap, the developer's remedy is termination for contractor default, not additional LDs. The DFI accepts this structure because the developer has other recourse: the performance bond, the parent company guarantee, and ultimately, the right to terminate and reprocure.
Let's talk about the construction schedule. The milestone structure drives the DFI Drawdown Mechanism. What does a typical schedule look like for a 24-month construction program?
A 24-month infrastructure project typically has 7 to 9 milestones. Financial close at month 0. Debt signed, first equity injection. Site handover at month 1. Developer transfers physical possession to the EPC contractor. Design freeze at months 3 to 4. Detailed engineering complete. Procurement can begin. Major equipment orders by month 6. Long lead items like transformers, turbines, treatment membranes are ordered early because their delivery time is 12 to 18 months. Civil works complete at months 12 to 15. Mechanical completion at months 18 to 20. All equipment installed. Commissioning and performance testing at months 20 to 22. And commercial operation date at month 22 to 24. Provisional acceptance certificate issued. Revenue commences. Debt service begins. The performance guarantee is the contractor's warranty that the plant will meet its technical specification. For an energy project, the guarantee covers net output in megawatts at defined ambient conditions, typically 98 to 100% of nameplate capacity. Availability, the percentage of time the plant is available for operation, tested over a defined period at commissioning. And for thermal plants, heat rate or efficiency, the fuel-to-output conversion ratio. For a water project, output in cubic meters per day and treated water quality meeting WHO or national standards. Performance LDs are calculated as the net present value of the lost revenue over the PPA life caused by the underperformance.
What happens if the plant fails performance testing? Does the developer reject it?
The contractor has the right to retest within a defined period, typically 30 to 60 days. If the plant meets specification on retest, the contractor pays the performance LDs for the interval between initial test and retest. If the plant fails retesting and remains below the reject threshold, the minimum acceptable output level defined in the contract, the developer has the right to reject the facility and claim breach of contract. In practice, rejection is rare because it means starting construction again. The developer will negotiate a commercial settlement covering the lifetime revenue shortfall instead. Now, construction bonds. Bonds are the financial security instruments that back the contractor's obligations. The DFI requires specific bonds as conditions of financial close.
What bonds does the DFI require, and at what values?
The DFI requires 4 primary bonds. The performance bond, an on-demand bank guarantee covering 10 to 20% of the contract value, which the developer can call if the contractor defaults. This is the most important bond. The DFI requires a minimum of 10%. The advance payment guarantee, a bank guarantee covering any mobilization advance paid to the contractor, which reduces as the advance is earned off through progress payments. The retention bond, an alternative to withholding cash retention from progress payments, preferred by contractors because it preserves their working capital. And for larger contractors, structured as a local SPV, a parent company guarantee from the rated parent company. The performance bond must be issued by a bank acceptable to the DFI and must be on demand. The developer calls it without needing to prove contractor default in court.
Change order management. What is the mechanism, and why do developers struggle with it?
Change orders are how lump sum contracts become reimbursable in practice. Every change order is a claim by the contractor for additional time and additional cost beyond the fixed price. Legitimate change orders arise from developer-initiated scope changes, unforeseeable site conditions, regulatory changes after the contract date, and force majeure. The developer must control change orders through 3 mechanisms: a clearly defined scope of work in the contract that leaves no ambiguity about what is included, a requirement for DFI prior written consent for change orders above a defined threshold, typically 10 to 20% of the original contingency budget, and an independent engineer review and certification for all significant change orders. The IE's role in change order review is critical. It prevents the contractor and developer colluding to approve changes that increase CapEx beyond the DFI-approved budget.
Force majeure in the EPC contract. How broadly should developers define it, and what are the risks of a broad definition?
Force majeure in an EPC contract should be defined narrowly, covering only genuinely extraordinary events that are unforeseeable, unavoidable, and beyond the contractor's reasonable control. Natural disasters, war, government actions preventing construction, and epidemics are standard qualifying events under FIDIC Silverbook. What must be excluded are ordinary construction risks the contractor has priced into the lump sum, bad weather within normal ranges for the site location, labor cost increases, materials cost inflation, subcontractor defaults. The hook scenario in this episode, force majeure claims for weather events lasting less than a week, illustrates exactly the problem with a broadly drafted FM clause. The contractor uses it to excuse delays that delay LDs should be covering. The cure is a specifically enumerated list of qualifying FM events with minimum duration thresholds.
Walk me through the completion certificates. What does COD, PAC, and FAC mean legally and financially?
There are 5 completion milestones with distinct legal and financial consequences. Mechanical completion. All systems are installed and connected. The plant is ready for commissioning. No financial consequence in isolation. The Provisional Acceptance Certificate, PAC, is the critical one. The contractor has passed performance tests, the plant meets its contractual output and availability specification, and the developer accepts it. Revenue commences at PAC. The DFI debt service obligation begins. Delay LDs stop accruing. The defects liability period begins, typically 12 to 24 months, during which the contractor must fix any defects. The commercial operation date may coincide with PAC or follow it depending on how the PPA defines the start of the revenue period. After PAC, the defects liability period runs until the final acceptance certificate, the FAC, is issued. FAC marks the end of the contractor's obligations. All defects must be remedied. The retention or DLP bond is released. The performance bond may be replaced by a smaller warranty bond or allowed to expire. After FAC, the developer has no remaining recourse against the EPC contractor under the construction contract, only the limitation period for latent defects under the governing law. This is why the DLP must be long enough, and the FAC requirements must be specific enough to capture all defects before the contractor's liability extinguishes.
The DFI Drawdown Mechanism. How does the loan facility actually release money to fund construction?
The DFI does not release the full loan at financial close. Debt is drawn in tranches, each triggered by the achievement of a construction milestone and certified by the independent engineer. Before each drawdown, the developer must satisfy a list of conditions precedent defined in the facility agreement. The IE certificate confirming the milestone is complete, the current ESMP compliance report, confirmation that insurance policies are current, and often confirmation that the CapEx to date is within the approved construction budget. The DFI typically requires equity to be injected before or pro rata with the first debt drawdown to prevent the developer exhausting equity before calling on DFI debt. IDC accrues on all drawn tranches from the day they are drawn and is capitalized monthly into the outstanding debt balance, increasing total debt and therefore the CapEx requirement. The independent engineer is the DFI's technical representative throughout the construction period. The DFI appoints and pays the IE. The developer has no control over the appointment. The IE reviews the EPC contract at financial close, identifies technical gaps, and produces a report to the DFI. During construction, the IE conducts monthly or quarterly site visits, issues progress reports, and certifies milestones before each drawdown. The IE reviews and recommends approval or rejection of significant change orders. At commissioning, the IE witnesses the performance tests and produces the PAC recommendation report. The DFI will not issue PAC and will not stop delay LDs from accruing without the IE's sign-off.
What is the developer's relationship with the IE during construction? They can't control the appointment, but they have to work with the IE daily.
The developer must cooperate unconditionally with the IE, providing full site access, submitting progress reports on the IE's required schedule, responding promptly to IE queries, and facilitating IE attendance at all milestone completions and performance tests. A developer who obstructs the IE, even unintentionally through administrative delays, can trigger a drawdown freeze. The most important preparation a developer can do is engage an experienced technical advisor early to identify and resolve any issues the IE will flag at financial close. EPC contract gaps, unqualified subcontractors, inadequate contingency provisions. These are all things the IE will find. Addressing them before the IE review saves weeks of conditions. Construction insurance is equally non-negotiable. Lapse of required insurance is a covenant default under the facility agreement.
What insurance policies does the DFI require as conditions of financial close?
The DFI requires 7 categories of construction insurance. Contractors all risks. CAR, covering physical loss and damage to the works during construction, with the DFI named as co-insured, minimum value equal to replacement cost. Third-party liability for injury or property damage to third parties, minimum USD 10 to 50 million per occurrence, depending on project size. Professional indemnity on the designer's errors. Marine cargo for equipment in transit from manufacturer to site. Business interruption for loss of revenue. Post-QIOD, due to insured physical damage. This is the DFI's key protection against revenue loss. Workers' compensation for all construction workforce, including subcontractors, required under IFCPS 2. And political risk insurance from MIGA, or the private market in high-risk jurisdictions.
Let's talk about EPC Contractor Pre-Qualification. The IE reviews the contractor at financial close. What can fail that review?
The IE's contractor review at financial close assesses 5 criteria. Track record. Has the contractor completed at least 3 projects of comparable technology and scale? A contractor with no reference projects in the sector will be flagged by the IE immediately. Financial capacity. Does the contractor have the liquidity and bonding capacity to absorb cost variations on a project of this size? The IE will review audited financials. Technical capacity. Does the contractor have in-house engineering, procurement, and construction management capability? Or is it entirely dependent on untested subcontractors? Safety record. The IE reviews lost time injury frequency rate and fatality history for the last 5 years. And parent company guarantee. If the contracting entity is a local SPV, the IE will require a PCG from the rated parent. A contractor who fails the IE review at financial close means procurement must restart. That can cost 12 months or more.
And the 7 EPC contract mistakes that actually delay financial close or blow up during construction. Let's go through them.
Mistake 1. No cap on liquidated damages. Uninsurable, unenforceable, contractor walks. Mistake 2. Cost plus or EPCM instead of LSTK. Open-ended CapEx kills the financial model. Mistake 3. Performance bond below 10% of contract value. The DFI requires at least 10%. Insufficient bond means financial close conditions cannot be satisfied. Mistake 4. No independent engineer appointed at financial close. The developer self-certifying milestones is not acceptable. DFI will not release drawdowns. Mistake 5. Force majeure clause too broad. Contractor claims FM for every weather event. Delay LDs become worthless. Mistake 6. No DFI consent required for change orders above threshold. CapEx creep erodes contingency without DFI knowledge or approval. And mistake 7. EPC contractor fails IE qualification. The IE rejects the contractor at financial close and procurement must restart. All 7 are preventable with early EPC contract structuring before the contractor is engaged. Sector-specific EPC considerations vary significantly. For renewable energy, solar panels and inverters have relatively short construction timelines of 12 to 18 months, but wind turbines have lead times of 12 to 18 months from order to delivery. The grid connection timing is the most common critical path item. If the national utility delays the connection, the developer is entitled to an extension of time, but is still carrying IDC costs on drawn debt. For water and sanitation, construction is civil-heavy, and the performance specification, output in cubic meters per day, and water quality must be tested rigorously before PAC. The defects liability period for water treatment plants is typically 24 months because membrane and equipment performance issues often emerge only after 6 months of operation.
And for transport infrastructure, which is typically the most complex construction in terms of linear extent and community interface.
Transport, road, bridge, and port construction presents the most complex EPC structuring challenge in Africa because the project is linear. It crosses multiple communities, multiple land tenure zones, and multiple ecological areas. Land acquisition on the critical path is often the bottleneck. If the developer has not completed resettlement under PS5 before construction begins, the EPC contractor will encounter people on site, and the construction schedule breaks down immediately. The DFI will require confirmation that all land is cleared and title is transferred before allowing construction to begin on any affected section. Milestone-based drawdown, where different sections of a linear project are funded as they reach completion, requires careful scheduling and IE coordination.
What does AIB Corp Ltd provide for a developer who needs EPC contract structuring support?
We provide 4 services for EPC contract structuring. First, EPC contract design. Structuring the LSTK contract on FADIC Silverbook, calibrating the LD rates and caps to the project's debt service profile, negotiating risk allocation between developer and contractor, and ensuring DFI bankability from the first draft. Second, bond and security package structuring, defining the performance bond value, advance payment guarantee, retention bond, and parent company guarantee, and pre-qualifying the contractor's bonding capacity before the contract is signed. Third, IE preparation, reviewing the EPC contract and contractor qualifications in advance of the IE's formal review at financial close, identifying gaps, and resolving them before the IE finds them. A developer who walks into financial close, having already self-assessed against the IE's checklist, saves weeks of conditions and reduces the cost of the legal process. Fourth, DFI construction monitoring support, managing the drawdown documentation package for each milestone, coordinating ESMP compliance reporting, and interfacing with the IE during the construction period. Details at du.aibcorpltd.com.
The overarching message I take from this episode is that the EPC contract is not the contractor's problem. It is the developer's structural document. Every risk that the developer fails to allocate to the contractor in the EPC contract will eventually be borne by the developer and financed by the DFI. Structuring the EPC contract correctly at the outset is how you protect both your equity and the DFI's debt.
Precisely. And the developer who says, "We'll fix the EPC contract issues at financial close," is already too late. By financial close, the contractor has been procured, heads of terms have been agreed, and renegotiating fundamental risk allocation takes months and often requires compensating the contractor for agreeing to terms they had not priced. Start the EPC contract structuring at the same time as the financial model and the offtake agreement. All 3 are part of the same bankability package.
Zara, let me summarize. The EPC contract is the document that transfers construction risk from the developer to the contractor. Only the LSTK structure is bankable. The fixed price, fixed schedule, and performance guarantees are what allow the DFI to size the facility against a known capex and a defined completion date.
The key instruments are delay and performance LDs sized to cover the developer's actual losses, both capped at 10 to 20% of contract value, performance bonds of at least 10% of contract value, IE appointment at financial close, change order control requiring DFI consent above threshold, a narrowly defined FM clause, and EPC Contractor Pre-Qualification confirmed before financial close.
The 7 mistakes: no LD cap, cost plus structure, weak bonds, no IE, broad FM, uncontrolled change orders, and unqualified contractor, are all structuring failures that occur before construction begins. They are all preventable if the developer structures the EPC contract at the same time as the financial model and the offtake agreement.
That is the discipline. The bankable project is one where the financial model, the offtake agreement, the ESIA, and the EPC contract are all structured simultaneously, each one supporting the others. A strong EPC locks the capex. A bankable offtake locks the revenue. A compliant ESIA provides the social license. A sound financial model quantifies the return. Remove any one of those four, and the DFI Credit Committee will find the gap.
If you need EPC contract structuring support for your African infrastructure project, go to www.aibcorpltd.com. AIB Corp Ltd provides EPC contract design, bond structuring, IE preparation, and DFI construction monitoring support for energy, water, transport, housing, and digital infrastructure transactions across Africa.
Subscribe to the AIB Corp Ltd channel. New episode every week. Episode 11 covers DFI engagement strategy for African infrastructure, which DFI to approach, how to structure the initial engagement, the information memorandum, the credit process, and a realistic timeline from first submission to financial close.
If this episode helped you understand how to structure an EPC contract that protects your project, share it with a developer who is currently in contract and negotiations. The earlier the structure is right, the less expensive the path to financial close. See you in episode 11.
10 episodes. 10 building blocks of a bankable African infrastructure project. Concept to close. Each one connects to the next. Each one must be correct for the others to hold. That is the AIB Corp Ltd approach. Systematic, disciplined, lender-standard project development for African infrastructure. AIB Corp Ltd.com